Let's get your trading week started. Live from New York City this morning. Good morning, good morning. Equities down by about 1/3 of 1%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, new week, same problems as shutdown risk lingers. Moody's taking a swing at America's fiscal health and Wall Street unveiling outlooks for next year. We begin with the big issue, an unsustainable trajectory.
We're really on an unsustainable path.
Fiscal policy is an issue.
Fiscal policy, obviously, it's a concern.
Just awful fiscal dynamics that aren't going away.
As a signal of how dysfunctional the U.S. policymaking is.
Just moving from one congressional crisis and government shutdown threat to the next.
We're going to see probably another alleged crisis on November 17th.
Risk of government shutdown.
Looming government shutdown.
It's really the length of any potential government shutdown is the issue.
If it's more than a few days, you have some impact that can be felt from an economic standpoint.
I do worry about the credit agencies.
There's Moody's rating.
There's a risk of, economic slowdown and potential recession. This could add to that.
We don't know what's going to happen.
Kind of an open question of how this all resolves.
Let's have that conversation right now with Academy's Peter Chair, Cameron Dawson of New Edge Wealth. Guys, great to catch up with you going into the opening battle to kick off this trading week. Cameron, let's start with you. Moody's taking a swing at America's fiscal health. A, is it justified? And B, does it matter?
Well, we haven't seen it matter much when we think about the downgrades that we saw earlier in the summer. But I think at the end of the day, we've had sort of the supply and demand dynamics around treasuries get put on the back burner for the market over the last couple of weeks as yields fell. But that could start to become something that becomes more top of mind. As we go into 2024, it's important to remember that that deficit to GDP is projected to improve a little bit to 6%, but that's in a strong GDP world, meaning that if you were to see nominal GDP start to come down or slow materially, and you see countercyclical measures, if we were to have a recession kick in, that could exacerbate debt to GDP more and then raise questions about, again, all those supply demand dynamics with treasuries. So I think it still should be top of mind for investors.
Top of mind for Bill Dudley, the former New York Fed president, with this to say on the situation. The situation is going to get worse because the government's debt is going to be repriced at much higher interest rates than we've had over the last 15 years. We do not have a very functional government in the United States right now in terms of getting things done. Two issues at play here, Pete. One is governance, the other is the debt pile. Let's deal with the latter, and then we'll get to the former later. The debt pile. Just how unsustainable is this, Pete?
I think it's completely unsustainable, right? We got away from the habit where we spend in bad times but kind of recover a little bit in good times. That's gone. As interest rates are rising, this is slowly kicking in. I mean, the Treasury did a decent job issuing long-dated bonds, but that's slowly rolling over, so the average coupon is going to tick higher. So just debt service alone is going to kick in more. And then let's not forget, the Federal Reserve was kicking in 150 to 200 billion a year positive profits that went back to fight the deficit. That's probably going to be a loss, if not this year, certainly next year.
Pete, looking at these numbers from Moody's, let's work through it together. Here's the quote from Moody's. They see federal interest payments relative to revenue and gross domestic product rising to around 26% and 4.5% by 23, respectively. That's up from 9.7 and 1.9. Pete, I'll go through that line again. They see federal interest payments relative to revenue and gross domestic product at 26% and 4.5% by 2033. Pete, underlying this is an assumption that we're in this higher for longer story, that these rates we've got to grapple with now are going to be sticking around. Do you agree with that, Pete?
No, I do think we're going to see some pressure on the economy. That's going to help take rates down. And ultimately, this is really going to come down to D.C., right? Can D.C. start figuring out a way to pay down some of the debt? Because that's the other factor, right? If we can get debt somehow down, which doesn't seem likely in today's environment, but it's going to be something they have to focus on, that will also alleviate that pain. So I think people are getting a little bit carried away that the higher rates are here to stay and that the debt trajectory is going to remain in trouble. So again, I think this is a problem, but it's not necessarily this year's problem. So I think that's where people maybe get too carried away.
Cameron, do you agree with that?
Well, I do think that there has been less urgency by Washington to pursue fiscal prudence or austerity. And part of that is because it seems to be less of a top of mind issue for the average voter. Because if we go back to post-Great Financial Crisis, that's when voters were very concerned about fiscal deficits. So it will be important to see if that starts to shift as we go into the election cycle next year. If that becomes more top of mind for voters, then it could be something that becomes more top of mind for Congress, and then we could see some different dynamics about spending and actually finding that prudence.
Well, let's talk about the prospect of finding that prudence down in Washington, D.C. Bloomberg's Anne-Marie joins us now for more. AMH inching towards another government shutdown.
Yep, Jonathan, we were exactly here where Speaker McCarthy lost his job. So now this is another high-stake negotiation for a new Speaker of the House, Mr. Johnson. Over the weekend, he outlined his plan, Jonathan, and it's a twist for a normal continuing resolution because now this would fund parts of the government to January and the remainder of it until February. So it's a two-step process because obviously the hard right flank of his party want to see cuts. And this is a clean resolution. So potentially giving some of that two-part scenario shows that he really wants to get these individual appropriation bills done. He took to Twitter, Jonathan. He said, Washington's spending addiction cannot be broken overnight, but I will not allow end of the year mega bust spending packages to continue under my leadership. The issue, Jonathan, is he's going to lose some Republicans. How many Democrats are going to be able to vote for this? The White House is calling this a gimmick, a recipe for more Republican chaos, but there's no poison pills in it. So if Democrats don't vote for it, could they be the ones potentially blamed for a shutdown?
What's the difference between what this speaker is trying to achieve and what the last speaker was trying to achieve?
The fact that it's a two-tiered approach, Jonathan, but it is a continuing resolution. A stopgap funding measure keeps the government open, and there's no big cuts to it. It's pretty much the same.
On the latest down in Washington, on the latest effort, which looks a lot like the last effort. Anne-Marie, thank you. Peter Scheer, Yellen says there's nothing to see here, that the debt position is good, it's fine. The usual line, the same line that we heard from the Treasury after Fitch made a move in early August. From your perspective, Pete, and I think this is important, just how safe is the so-called safe asset?
You know, first, I think she has to say that because that's her job and it's ultimately a political appointee. So I take everything she's saying with that in a grain of salt. I think people are starting to question where they want to be in treasuries and where they want bonds. So we're having a lot of conversations. If treasuries are still safe, but maybe not quite as safe as they were, how do you position yourself? And I'm not worried about default at this time, but I am worried about this volatile trading that we're seeing and this potential for gap risk. So, you know, you start seeing maybe days we go 50, 70, 80 bips higher in treasuries down the road in a day. I think that's what I want to avoid. So I'm looking at floating rate debt. I'm looking at corporate debt. And to be honest, you watch Bitcoin's been doing very well. And I'm not necessarily a fan of crypto, and part of that's obviously been what's going on with the potential launch of the ETF. But I do believe some people are saying, hey, if maybe not 100% of my safe asset should be in treasuries, I should find something else. And I think that's a trend that's going to continue until something gets solved out of D.C.
Cameron, are you looking elsewhere for so-called safety?
Yeah, I mean, I do think we have to respect the uptrend in long Treasury yields, meaning that, yes, we had this movement lower, and that really led people to say we've had the peak in yields, Treasuries can be safe again, and yet we pulled back to the 50-day moving average. We still are kind of drifting higher, which means that we still have that prospect for higher yields, which just means that the call to move everything from being a short duration fixed income and piling into long duration fixed income for that kind of safety trade likely still is premature. So it's not to say that you can't extend duration in certain areas, but you have to do it very carefully because the 10-year is still in an uptrend.
Pete, we had this conversation with Neil Kashkari, the Minneapolis Fed president. We alluded to some of these difficulties, and Pete, he made the point, and I think it's an important point as well. If there were concerns about financing the deficit, why was the dollar stronger and not weaker? Pete, what would you say back to that?
You know, I think, one, there's a lot going on with the dollar. I think Japan's been fairly weak and having problems there. I think the U.S. economy is strong, so that's part of it. People do need dollars. So, and again, I think part of what Cameron just said is also very correct. People aren't necessarily shifting completely away from treasuries, so they are buying T-bills, though, rather than long-dated treasuries. So maybe they're buying more of them. We'll give that time to see how it plays out. Again, I think the one thing, none of this is going to happen in a day, a week, a month. I think this is multi-year trade. I keep coming back to the great financial crisis. Started initially cracking in 2006, and it wasn't until 2009 that we bottomed.
It takes a while to play out. Pete, stick with us alongside Cameron Dawson. We'll talk about their outlooks for 2024 in this equity market specifically in just a moment. About 20 minutes away from the opening bell, equity futures on the S&P pulling back 1/3%. Let's get you some movers. Here's Abby.
John, let's take a look at two leaders ahead of looking at one of the drags, at least on the NASDAQ, starting out with the shares of Tesla and then Boeing. Both of these companies moving on news having to do with other countries. Tesla is higher, up about 0.8% as India is weighing a 5-year tax cut plan on EV imports, trying to get Tesla to both sell Tesla cars in India and potentially to manufacture them at some point. Boeing up 4% as China is weighing in ending its freeze on the 737 MAX deal. And then finally, Plug Power heading to a 6th down day in a row, a member of the NASDAQ composite last Friday, down 40%, the worst day since 2014 on a bad quarter and going concern risk. Well, today, Morgan Stanley has cut its target on that warning. It seems as though Plug Power can't get a break, John.
Abby, thank you. More from Abby around the opening bell. Just keep an eye on Boeing. Positive in the pre-market. We are expecting a bit of a charm offensive from Chinese officials coming to the United States later this week. We'll talk about that a little bit later this morning. Coming up on this program, Goldman and Morgan Stanley diverging on the Fed's road ahead.
We're still faced with this pretty bearish, pretty pessimistic setup, which continues to allow pretty positive surprises.
Wall Street unveiling their latest Fed bets ahead of a big CPI report tomorrow morning. That conversation up next.
Probably going to get, core PC inflation below 3% by the second quarter of next year, right? So it's not miles away. It's not like we're talking about, sometime in 2025. We're talking about in 1 or 2 or 1.5 quarters. And suddenly, perhaps, real rate, the real federal funds rate is then going to be way, way, way too restrictive. And then the market and the Fed can start talking about rate cuts. You're actually going to continue seeing a pretty Goldilocks-y environment.
I've got no idea what that means, but that was Max Kettner of HSBC saying Goldilocks is back. It's that time of the year. Crystal ball time. Looking out to 2024, a tale of two Fed outlooks, Morgan Stanley versus Goldman Sachs. Goldman expecting fewer cuts and a later start. Morgan Stanley anticipating deeper rate cuts over the next 2 years, ending in the low 2% range in Q4 25. Morgan Stanley's Ellen Zentner writing this: we maintain our view that the Fed will achieve a soft landing, but weakening growth will keep recession fears alive. Mike McKee joins us now for more. Morning, Mike.
Morning, John. With apologies to Ellen and David Miracle at Goldman Sachs, I kind of put this in the category of all the political polls we've been reporting on lately. Value add? Nothing. It's years away. Take a look at the latest dot plot from the Fed. I put Morgan Stanley and Goldman Sachs into the 2025 numbers there, and you can see they are sort of right in line with everybody else. They're far apart. The Fed doesn't know. Nobody knows. It's 2 years away. How do we even make a sense of any kind of predictions about what's going to happen there, given what we've been through for the past 3 years? Instead, we just kind of have to slog through the data release by release. Today, we get the New York Fed's inflation expectations numbers. And then tomorrow, as John mentioned, CPI. How important will it be? We're still 5 weeks out from the Fed meeting, so it may give people something to trade on, but it's not going to be dispositive for the Fed. Same with retail sales, jobless claims. The rest of the stuff that is on the list it's just not going to be as let's say, future predictive as people on Wall Street would like. We have a lot of Fed speak again, 20 appearances this week, 11 different Fed speakers, and I think we could probably, John, put the conclusion out already that they're basically all going to say data dependent and we're going to move carefully because they've got 5 weeks to go. It's one of those rough times, and Will Comperdole of FHN Financial probably put it best, and he said that in his note today that what Wall Street is looking for is an anchor for what Fed policy is going to be. And there is no anchor at the moment. We don't know if it's going to be inflation. We don't know if it's going to be jobs. We don't know if it's going to be the wars overseas. A lot could happen that would change narratives between now and 2024, let alone 2025. And that's the hard part for people who are investing at the moment.
Oh, Mike, it's difficult to get past next week. I think we say that all the time on this program, never mind 2024 and 2025. Mike, when you look across the data set we get this week, how much weight would you put on, say, CPI versus retail sales?
Well, I think CPI is going to be more important in the sense that it will give us an idea of whether the Fed is still making progress, and that will sort of inform, if not confirm, people's views of what might happen at December 13th meeting. But retail sales will also tell us something about whether Americans are still spending, and that's always been the surprise every month, that Americans continue to spend money that economists have forecast they'd run out of.
It's held up so well. It's ridiculous. Mike McKee, thank you, sir. Peter Cheer, Cameron Dawson back with us. Pete, what we see in the data so far, consumer sentiment a little bit lower, claims a little bit higher. Is the slowdown coming next?
Yeah, I think we're already started that slowdown. We're seeing lots of little anecdotal evidence, whether it's in freight, whether it's in shipping. It hasn't come in completely in the numbers, though the last month's job numbers were not great. So I think we are in the midst of this slowdown. I think we're going to get maybe not a hard landing, but something less than a soft landing. I think people are going to get nervous about the state of the economy, and the Fed is going to have to balance that with the fact that there are inflationary pressures. And whether you want to call it geopolitical inflation, ESG inflation, reshoring inflation, those pressures are real. So that's going to be, I think, a difficult balancing act for the Fed to deal with.
Pete, I remember when you, Mitch, used to make this Federal Reserve nervous. What changed?
That I do not know. And they do tend to look at, again, I've never completely understood why they fixate so much on consumer expectations. Right. I always go back to Michigan and Consumer Confidence Report. It tends to reflect what gas prices have done and what the stock market have done. So I've always ignored it largely.
That was what was odd about Friday, because gas prices have come down a little bit, but expectations for inflation just shifted a little bit higher. Two-part question for both of you. Cameron, I want to come to you. Is Q4 too soon to see this economic slowdown materialise in a more pronounced way? And do I still have a window to be long equities going into year-end?
Yes and yes, meaning that, so for the Q4 slowdown probably being far too soon, is that we're unlikely to see that sharp deterioration in labor data going into the end of the year, and that it really is more of a 2024 question, which just means that consumer spending, though maybe getting continuously pinched by inflation, can continue to remain elevated or healthy simply because when consumers have jobs, they will continue to spend. And so I think that that really will keep equities supported into the end of the year, as well as all these dynamics about window dressing and no tax loss harvesting in the largest names in the index. The thing we have to watch really closely is earnings revisions, because we've started to see them erode for 2024. Part of that is because economic surprises have turned meaningfully weaker over the last couple of months, meaning economic data is not surprising as much as it was. So if that continues and we see earnings revisions continue to erode, that could be an interesting setup for 2024.
Pete, do you look at things the same way?
Similarly, I think there's more chance that we see some recession data creep in Q4. Having said that, though, I think that will just help keep yields lower, so stocks can probably rally on that. And we are watching really closely what's going on in these talks between China and the U.S., right? With so many problems going on geopolitically, there is a chance that the Biden administration reaches out an olive branch to keep China calmer while we're already dealing with Ukraine, while we're dealing with what's going on in Israel. And so that could be a big positive for markets. I think it would probably be a long-term bad step, but it's something that we could see happen.
Pete, you've got a firm filled with generals. Let's just sit on that topic just for a moment. China and the United States, Xi with Biden. You mentioned some of the reasons for Biden maybe to go on a charm offensive. Do you think there are bigger reasons for China to do the same thing, given the data point that we've seen in the last week or so, to see foreign direct investment into China turn negative? How important is that data point going into this conversation?
So I think there's two things about that. One is at a very high level, anything that's national security risk that's going to stay off limits. So that we're not going to cave in. We're not going to do anything to help China in that respect, because it is a very serious thing. But the key is, what can you do that's not national security interest that allows some re-globalization to occur? And yeah, I think China has to look for some short-term investment. So I do think we're seeing evidence of what we've been calling this made by China strategy, where China is selling their brands into more countries, particularly emerging markets. So some of that foreign direct investment may start coming from other countries over time. But yes, I think both sides would probably do well right now to come to some sort of deal. And it feels to me, though, that China's probably a little bit more in the driver's seat, given that they are not in the midst of all these geopolitical issues and deficit issues.
Hey, Cameron, we've got a stacked calendar this week. Let's just finish on what's big on your radar. We've got data, CPI, retail sales, earnings, Walmart, Home Depot. We've got Fed speak, tons of it. Then you've got geopolitics. What's big on your radar this week?
Yeah, it's all about the consumer and seeing if there is any deterioration in retail sales and what Walmart and Home Depot are saying about the health of the consumer. We know that consumer balance sheets are still relatively healthy. They're really back to about 2019 levels when we look at things like percentage of revolving credit or looking at things like credit card delinquencies. But as savings are whittled down, will we start to see the consumer tighten the belt? And then that leads into the question of, will this holiday season be a source of upside surprise or a downside surprise when it comes to consumer spending?
I'm with you. Cameron, thank you. Alongside Peter Cheer, Cameron Dawson there on the latest. Got into a stacked week. Talking about the consumer, retail sales Wednesday, CPI tomorrow morning, then tons of retail earnings in between to try and get your hands around. Equities right now slightly negative on the S&P 500. We're down 1/3%. Coming up, the morning calls, and later, Goldman and Morgan Stanley unveiling their 2024 equity outlooks. That conversation still ahead. We'll get the views of BlackRock. Tony DeSpirito, the US Fundamental Equity CIO, joining us around the opening bell from New York. This is Bloomberg. Squeezing out 2 weeks of gains on the S&P 500, 5 minutes away from the start of a brand new trading week. Equity futures just a little bit softer, down by 1/3% after a really impressive finish to last week in Friday's session. Even with this move in the bond market, shaking off the fact that the 2-year is back north of 5%. At the moment, the 2-year up another basis point to about 5.08%. Just one to watch, keep an eye on through the trading session. That's some of the price action. Let's get you some morning calls. First up, Bernstein upgrading TripAdvisor to outperform, expecting a return to profitability due to strengthening travel demand next year. That stock is up by a little more than 2%. Your second call from Citi, upgrading HP to buy, $33 price target, pointing to bullish PC momentum and potentially higher free cash flow generation. That stock is up by a little more than 1%. And your third and final call from Odeon Capital, downgrading Regions Financial to hold, highlighting the stock's historically soft performance during periods of economic weakness. That stock is down by almost 1% in early trading. Coming up, strategists unveiling their equity outlooks for the year ahead. Goldman Sachs and Morgan Stanley not seeing eye to eye. That conversation up next with BlackRock's Tony DeSpirito. Tony's joining us shortly. Your opening bell is just around the corner. 25 seconds away from the opening bell this morning. Good morning to you all. This week is absolutely stacked. CPI coming up tomorrow morning, retail sales on Wednesday, tons of earnings in between. And for those of you who like it, I know a lot of you hate it, got a sprinkle of Fed speak in the mix as well. Your opening bell rings in New York City. Switch up the board and get to the bond market. Yields look like this on a 10-year, higher by 2 basis points, 467.57 on a 10-year after a sloppy bond auction on a 30-year maturity last week. Spooked equity investors for the best part of about 5 minutes before bouncing back. In the FX market, the dollar showing a bit of strength, the euro some weakness on that currency pair, pulling back 0.1%, 106.74, and crude just about positive on the day by, let's call it, 6 cents, up about 1/10 of 1% to $77.22. Your broader equity market about 30 seconds into the session looks like this. We're negative by 0.3% on the S&P, down by about 0.4 on the Nasdaq. One stock to watch at the open is Boeing, as China considers ending a freeze with its 737 MAX. A Boeing executive saying, quote, "Our job is going to be express to the Chinese the need to replace their fleets and provide growth for the future." Abby has more. Hey, Abby.
Hey, John. Well, the stock is certainly popping on this, up more than 3%, heading to its best day potentially since July. And it is on this news that China's freeze in the 737 family could end, a clear positive for Boeing and potentially the country as well, a bit of a thawing amid tense trade relations. Now, for Boeing, it represents a chance to jumpstart sales of its narrow-body jet that, of course, has been grounded to some degree, and no pun intended, since 2018 when there were 2 air crashes. China has not made any significant purchases over that time. So as a result, Airbus, its competitor, has really taken a lot of market share. Now more than 1,000 of their jets are out there, whereas Boeing has really stayed stalled since 2018, right around 950 jets or so. Now, they do have apparently 85 737 MAX jets in storage intended for China, and restarting those deliveries could help the plane maker reach its target of shipping between 375 and 400 of the jets this year. Clearly a positive. The Xi-Biden meeting at APEC in San Francisco on this week, John. Well, clearly it's opening the possibility of a door to restart and reset trade on aerospace. Unintended positive, perhaps, and the stock, again, best day since July.
Just a little bit more constructive. Abby, thanks for that. The stock is up by a little more than 3%. Let's turn to pharma. More good news for Novo Nordisk, as its weight loss drug shows it can help reduce heart attacks and deaths. The CEO saying this: physicians are understanding that this is not just about weight and appearance, it's about real health benefits. Madison Muller joins us now for more. Hey, Madison.
Hi. Yeah, so it seems like it's weight loss drugs all the time. There is news every single day. Today, the story is Novo Nordisk reporting details from a very closely watched study of its weight loss drug Wegovy over the weekend at a medical conference in Philadelphia. And what we're seeing is that there might be benefits for patients' health beyond just that weight loss. So in this study, heart attacks and strokes were cut by 20%. And that's due to anti-inflammatory effects, reduction of blood sugar. This is the first in many studies that are happening that we're really starting to see all of the potential benefits of these drugs for patients beyond just the number on the scale dropping. So it's an exciting time for Novo Nordisk. There's some read-through to Eli Lilly, which is also developing a weight loss drug called Zepbound. And it remains to be seen what the other knock-on effects of these drugs will be.
This could totally change this economy. Madison, thank you. That stock's a little bit lower this morning. We're down 2.7%. But year to date, Novo Nordisk is up by something close to 50%, up by about 47% on my read on the Bloomberg right now. Let's turn to consumers. JD.com reporting sales growth after Singles Day in China, but newer social media platforms outpacing them. Katie Greifeld on the story. Hey, Katie.
Hey, John. Yeah, Singles Day. It's China's version of Black Friday, and signs this year point to it being a little bit of a letdown. You had both Alibaba and JD.com choosing to not disclose their overall revenue figures for a second year. So it's hard to know for certain. We did hear from the companies. Alibaba said that sales growth was positive, and JD.com said that revenue hit a record. That's, of course, the company line. Meanwhile, you take a look at analyst estimates that point to both Chinese e-commerce giants likely only seeing double-digit or single-digit gains, even after, of course, that heavy discounting period to draw in reluctant customers. Now, given that Singles Day has become this barometer for Chinese consumer sentiment, this is perhaps another worrisome signal. You did mention, of course, some of the smaller streaming platforms maybe saw double-digit sales growth. That is according to Bloomberg intelligence estimates, but that's little comfort to JD.com. You can see shares about 0.1% higher right now, though they've been fading basically since the bell rang.
Pretty much unchanged now. Katie, thanks for the update. Appreciate it. Let's turn to earnings. Tyson Foods missing estimates as it deals with higher costs. The CEO saying this: while economic headwinds persist, we are moving in the right direction and managing what we can control. Simone Foxman has this one. Hey, Simone.
Hey, John. Yeah, losing money across beef, chicken, and pork segments, but the focus really in the pre-market where shares were down, now we're seeing them a little bit higher, was on the beef, taking an impairment charge of $333 million on its beef operations in the fourth fiscal quarter. Now, part of this is overall what's happening in the beef sector. There are fewer cattle available in the United States. The U.S. herd is actually its smallest in almost a decade. So that means that producers like Tyson have to pay more for their fat cows, and that erodes profits. Also, the CEO talking about how this impairment is also due to higher interest rates. When we look through the earnings, see a little bit more of a mixed picture. Earnings per share were a bit ahead of estimates, and adjusted 37 cents to the 25 cents analysts were expecting. Down, however, 77% from a year ago. Sales coming in just a little bit light at $13.35 billion. And the outlook is not particularly better next year, saying that the revenue outlook's relatively flat in 2024. With chicken production expected to really speed the company, trying to cut costs where it can, hoping the chicken business picks up. But shares are down 23% this year. Maybe that's why we're seeing a little bit this reaction, not as bad as potentially feared, John.
Tiny bounce. Simone, thank you. Up by close to 2% there, about 47.90 on that name. 6 minutes into the session, broader market looks like this, negative 0.4% on the S&P, down about 0.5% on the Nasdaq. It's outlook season. It's that time of the year, crystal ball type stuff. Goldman Sachs, Morgan Stanley diverging over the outlook for stocks next year. Goldman's David Kostin writing this: many investors are concerned about downgrades to consensus earnings forecasts, but they're tracking in line with the typical patterns. A less optimistic Mike Wilson over at Morgan Stanley writing this: the near-term backdrop remains challenging. Earnings revisions breadth has rolled over once again, and underpinning this trend is more cautious corporate commentary. These factors suggest earnings headwinds will likely persist into early next year. Let's start the conversation now with BlackRock's Tony DeSpirito. Tony, two views there, two peers, Morgan Stanley, Goldman Sachs, Wilson, Kostin. Let's get to your view for next year. How difficult is it to go into the crystal ball and look out to 2024?
Yeah, so I think in terms of the outlook for stocks broadly, we're about in line with historical averages. You know, I look at equity risk premium, and we're a little lower than average, but pretty much in line with historical averages. So I feel comfortable there. And then where I feel really excited is the opportunity for stock picking. I see a lot of dispersion. I see dispersion in valuation. I'm seeing dispersion in earnings. And I think that's really good for skilled stock picking. So I'm kind of medium on the market overall, but very optimistic on the opportunity for stock pickers like myself.
Tony, let's get into that just a little bit more. The approach post-GFC, after 2008, 2009, where you just hugged the index and didn't let go, and you benefited from that. And I wish people understood that at the time, because, of course, it sounds easy now, but at the time it wasn't. Tony, how different is this regime going to be compared to what we witnessed over the previous 10 years?
Yeah, so I think very different. That post-GFC regime, I call it the buy the dip error, where the Fed was constantly fighting deflation with easy money, ultra low rates. And what that resulted in was very high returns. Actually, equities in the U.S. were up over 17% per year during that whole time period, which is a long time. And volatility was depressed versus historical averages. Going forward, we're going to have this push and pull about inflation, but secularly, there's just going to be more inflationary pressures going forward. So instead of fighting deflation, the Fed's going to have to periodically fight inflation, whether it's because of demographics slowing, whether it's because of deglobalization, what's going on with the U.S. and China, that's inflationary, reshoring of supply chains, or decarbonization. All of these things are inflationary pressures. And so that means the Fed's going to have to constantly be fighting inflation, raising rates. And I think that creates a very different outlook. It creates one that's more neutral for stocks. It's fine, but more neutral. And then also it means more volatility, and the volatility is what's good for skilled stock pickers. And I say skilled stock pickers because we all know alpha is a zero-sum game.
Tony, with that in mind, just given what you said about the Federal Reserve, what's the argument for equities over fixed income in the regime you just described?
Yeah, well, I think it's much more like go back to history. And so one of the things that we did was we looked back since 1957 when the S&P 500 started. And if you look at that time period, actually the average 10-year Treasury during that time period is 5.75%. So yeah, today's rate of 4.65 or 4.67 may look high relative to what we've gotten used to in the last 15 years, but by historical standards, it's still pretty modest. And in that kind of environment, I think equities can outperform bonds.
And Tony, we're trying to work out where we are right now before we look out too far into the future. Where do you think we are in the cycle? And given that, what should that mean by where you should be in this equity market?
Yeah, so I just described the secular pressures towards higher inflation. I do think cyclically we're in a period of disinflation, which is good. And that means we're kind of in this Goldilocks state where the economy has been able to be strong while the Fed has been able to take the heat off of inflation. So no one's worried anymore about a inflationary spiral. So I think that's pretty good. But we have to recognize that we're in the later stages of the economic cycle. Unemployment is pretty low, 3.9%. There's not a lot of slack in the economy. And so what I see is my favorite trade is the up in quality trade. A real focus on quality of business, quality of balance sheet, quality of management teams. And historically, this is the time to own quality. Quality tends to outperform in the late stages of an economic cycle. It tends to outperform after the Fed is done hiking. Yet, when I look at the marketplace, quality is actually trading at a discount to its historical multiples. So usually quality trades at a premium to the S&P 500. Today it's at a slight discount to the S&P 500. So I think it's a great opportunity for investors to move up the quality scale. That's what I'm doing in the funds I run, like the equity dividend fund, for example.
Tony, with that in mind, why do you think it is trading at a discount?
Yeah, I think it's a little bit, investors are chasing the new thing. We've had a lot of great themes this year, like AI, like the GLP-1s, the weight loss drugs that you talked about before, et cetera. And so I think there's a little bit of tendency to just chase momentum as opposed to really dig in to quality and valuations and margin of safety. The result is that's where the opportunity is.
Tony, appreciate the update from you, sir, as always. Tony DeSpirito there of BlackRock on the year ahead and the cycle ahead of us as well. Your broader equity market at the moment is negative 0.4% on the S&P. We're down about 0.7 on the NASDAQ. If you'd like an update on the bond market, I'll give you one just briefly. Yields are higher at the front end by about a single basis point, just north of 5%, 5.07 on a 10-year currently up by 2 or 3 basis points. Your 10-year currently at 468.37. Further out along the curve, we had that disruption, didn't we, at the back end of last week, that sloppy 30-year auction, things settling down just a touch. We're higher by 4 basis points. Your yield there, 480. Coming up on a program, looking for China's charm offensive.
When it comes to managing the relationship, ties and communications between our two militaries are critical. The Chinese have basically severed those communication links. President Biden would like to reestablish them.
That's the goal of this week. Xi meeting Biden. That conversation up next.
When it comes to managing the relationship, ties and communications between our two militaries are critical. The Chinese have basically severed those communication links. President Biden would like to reestablish them, and he will look to this summit as an opportunity to try to advance the ball on that.
National Security Advisor Jake Sullivan there setting the scene for high-stakes diplomacy in San Francisco this week between the U.S. and China. Presidents Biden and Xi meeting face-to-face for the first time in a year, both looking to stabilize shaky ties. The meeting opening a door to reset trade on aerospace as China weighs a commitment for Boeing's 737 jetliner, ending a long commercial freeze in a critical overseas market for the U.S. plane maker. Your team coverage starts right now with Bloomberg's Anne-Marie and Katie Lyons in Washington, D.C. AMA, set the scene for us this week.
Well, Jonathan, the two leaders, Joe Biden and Xi Jinping, will be sitting down, leaders of the two biggest economies for the first time in a year. But, Jonathan, there's no clear breakthroughs that the administration is outlining or the Chinese government is outlining. But there's going to be a slew of items on this agenda when it comes to geopolitical concerns, economic concerns, human rights concerns. But it seems like the one potential deliverable, if you want to call it, will be more communication, military to military communication. So basically going back to the normal cadence of dialogue between Beijing and Washington before then Speaker Pelosi took that trip to Taiwan last summer, Jonathan.
We've talked a lot about the potential for a charm offensive here on both sides. Katie Lyons, is Boeing the winner of that?
Well, at least the shares look to be on reports that they could indeed be a winner of a thawing of relations between the U.S. and China, because according to Bloomberg's reporting, citing sources familiar, China could be making a commitment to the 737 MAX at this APEC summit this week. Remember, this is an aircraft that has not seen a massive order in China since at least 2018, after it was grounded by China globally, and then globally in March 2019 after a series of crashes. But part of the concern was no longer just safety concerns. All of that largely has been put to bed. It was really an issue of the relationship between the U.S. and China and the real freeze that it had on commercial activity. So China's potential commitment that they could unveil, that the sources familiar who have spoken to Bloomberg have suggested this isn't final, things could still change, nonetheless would be a really big win for Boeing in a market where they have been consistently losing ground to Airbus. It is the A320 that has well overtaken Boeing to be the most used single-aisle aircraft in China. So this could be a big win for them. But of course, Boeing is notching up other wins in other areas as well. At the Dubai Air Show earlier today, Emirates committing to a $52 billion deal to buy 777X, that wide-body aircraft. So a couple wins for Boeing here, and you're seeing the stock reaping some reward this morning.
Expect more from Guy Johnson on that in the next couple of hours. I'm looking forward to Guy's view on things. Anne-Marie, just to come back to you and talk about the two meetings that are taking place. It's not just Biden and Xi. It is also Xi with business leaders in America. Anne-Marie, how key is that going to be?
Well, listen, Jonathan, Xi Jinping clearly wants to bring in foreign investment. He wants to make sure that business leaders know that China is still open for business. You saw the number of CEOs that were there over the course of the last few months, like Jamie Dimon, like Elon Musk. China is still struggling economically. There wasn't this massive pandemic resurgence of their economy that we've seen happening, say, in the United States. They have a very high unemployment rate. They have a dwindling and a lot of pressure on their property market. So for Xi, this is a really important meeting, but also for these executives that want to know what it looks like to continue to invest in China. So for Xi, I would say this is almost as important as his meeting with President Biden, but obviously sitting down with America Inc. CEO for President Xi is going to be paramount.
Would you go as far as saying that this meeting, this visit, is more important for Xi than it is for Biden?
Potentially, when you look at the state of the Chinese economy versus the U.S. economy, I would say this is incredibly important. We also have seen a number of U.S. officials go to China. This is the Chinese president's first visit to the United States in years, Jonathan. And it's not just going to be with President Biden. There's a number of other leaders attending the APEC forum, but also with executives. But remember, he has not really taken a ton of trips following the COVID-19 pandemic. So for Xi Jinping, this is a really important moment coming to the United States.
Katie, I joked earlier that maybe cities across America would like Xi to visit them because a big cleanup act has taken place, hasn't it, in the last couple of weeks in San Francisco?
Well, yeah, that's very true. It's interesting that the summit is happening in a city that has really been a focal point for a lot of issues, including crime being one. But to Anne-Marie's point about how Xi has a lot at stake here when it comes to the Chinese economy, for President Biden as well, while this is a really high-profile accomplishment, if you will, on the geopolitical stage, being able to meet face-to-face with Xi Jinping and resume more normalization of ties, as she said, the military would be a big win. We have to keep in mind this comes off of Bloomberg polling last week that showed the president is really falling behind former President Trump in swing states on foreign policy issues on which they trust former President Trump more. And foreign policy issues just aren't resonating voters with the same extent that issues like the U.S.-Mexico border are. So how much does the China win really help the U.S. president? At least electorally, that remains very unclear, John.
And in that poll of ours, big margins on those fronts. Katie, thank you. Katie Lyons alongside Anne-Marie, AMH down in Washington, D.C. You brought a market 22 minutes into the session. Equities negative 0.4%. Let's get you some sector price action. Here's Abby.
So that's a relatively modest decline for the S&P 500, John, but it is broad-based. If we use the IMAP and the Bloomberg terminal to take a look at what's happening beneath the surface for the S&P 500, most sectors, 8 of the 11 sectors are lower, and industrials, in fact, up ever so slightly to the downside, real estate, and then those 3 mega cap tech sectors all down more than 0.5%, dragging. Energy is up just a little bit, up about 0.5% as oil gets a bit of a bid. And then consumer staples, a defensive sector, also higher. Now, you were mentioning earlier that retail sales out on Wednesday, and then a lot of these big box retailers such as Home Depot tomorrow, Target on Wednesday, TJ Maxx on Wednesday, reporting this week. Ahead of that, we're looking at the best month for the discretionary retail index going all the way back to June. So it seems some investors are optimistic.
A bounce there. Abby, it's been a difficult time for them going through the summer, particularly some of the airlines really struggled from, I think, the peak back in July, really started to roll over, maybe softer demand domestically, higher fuel prices. Let's see if we can unwind some of that. Abby, thank you. Coming up, I've said it a few times in the last few hours this morning, an absolutely stacked week ahead. I'll bring you the calendar, the trading diary, up next. 25 minutes into the session, early days, just starting the week on a softer note. We're down about 0.5% on the S&P. That's the price action. Here's the week ahead. The trading diary absolutely stacked, packed. Tuesday, we'll get US CPI and Home Depot earnings. Wednesday, US PPI, US retail sales and earnings from Target. Plus, President Biden meeting with President Xi Jinping at the APEC summit. Thursday, another round of jobless claims and earnings from three more retailers, Macy's, Walmart and The Gap. And finally on Friday, it's the US government shutdown deadline expiring at midnight. There's a week ahead for you. A quiet start to a very busy week, which picks up big time tomorrow morning with the US CPI. Looking forward to covering all of that with you. Thank you very much for choosing Bloomberg TV and good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.